Welcome to Finance Today. Today we're going to go over different stock exchanges and different set it and forget it long-term investment vehicles for investors. The goal of investing is to grow your money through different investments or assets. Investments don't guarantee returns, and investing in the stock market can be especially risky. You as an investor have to determine your own goals and risk tolerance. Because the stock market can be a risky place, investors diversify their portfolio to reduce risk. Limiting your risk while looking at potential upside is the key to smart investing. If you're an investor and you take all of your money and you put it into only one stock, you're essentially putting all of your eggs into one basket. If that stock goes down in value, you're not protected, you have no hedging against your bet, you're going to lose money. Now, if you take your same money and diversify over 10 different stocks, you're insulated. If one stock goes down, the other 9 may go up. You have diversified your risk by spreading your money over different stocks. There are a few different funds available to investors that diversify your money for you. Today we're going to go over 3 different types of funds. We're going to go over mutual funds, index funds, and exchange traded funds, or ETFs. Before we dig into the funds, we're going to do a quick recap on the different exchanges that stocks are traded over. So stock exchanges help pair buyers to sellers seamlessly so that you can trade assets within the blink of an eye. So in the United States, we have 3 main exchanges. We have the New York Stock Exchange, we have the NASDAQ, and we have the over-the-counter bulletin board. The New York Stock Exchange and the NASDAQ are the 2 more commonly known stock exchanges, and the OTCBB offers investors small cap companies, commonly referred to as penny stocks. Now, each of these exchanges has different regulations and requirements to be listed on the exchange, and different practices that businesses have to follow through once they're listed. So these requirements usually begin with a prospectus that companies have to offer to the SEC and the stock exchange that they want to be listed on, and they're maintained throughout accounting practices, earnings calls, guidance. So the first fund we're going to cover is a mutual fund. Mutual funds were the first diversified portfolios that were offered directly to investors. Mutual funds began over 100 years ago, and they typically have baskets of right around 100 stocks that investors can buy into. Now, in investing, diversification is key, and if you were trying to build a basket yourself of 100 different companies, you would spend an incredible amount of time looking at stock correlations and individually hitting buy on each of the 100 stocks. So a mutual fund is a nice package that comes pre-diversified for investors. Mutual funds are typically actively managed. This means that there is a finance professional actively reallocating the stocks that are in the fund. Theoretically, this means that a finance professional should be able to invest more money in stocks that are doing well and divest in stocks that are underperforming. But really all this means is that you have to pay a lot of fees. Mutual funds are notorious for being expensive. They typically collect around 2% of your total assets annually. This means that if you're investing $10,000 into a mutual fund, you're paying $200 directly to the manager of the mutual fund, regardless of the performance of the mutual fund. This fund could lose you money and you're still paying 2% every year. Now, the second type of fund that we're going to talk about is called an index fund. Indexes are supposed to measure the performance of the broader stock market. 3 of the indexes that you might have heard of are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite. The Dow Jones Industrial Average takes the 30 largest publicly traded companies and gives you one number to signify how they're doing. The S&P 500 takes the 500 largest companies, and the NASDAQ Composite takes all of the companies that are traded on the NASDAQ. There are around 3,000 of those. But each of these indexes measures a different basket of stocks and gives people one number to look at. So when people ask, how's the market doing today? They're referring to the Dow Jones Industrial Average. It would take somebody a lot of time to look up 30 of the largest publicly traded companies and track how each of those individual companies did that day, and then tell somebody how the market performed. The Dow Jones Industrial Average gives people one number to look at. There are indexes for every different sector of the economy: finance, energy, retail, etc. Index funds give investors the choice of mirroring each of these different indexes. If an investor is bullish on energy sector, they'll buy an energy index fund that contains all of the largest publicly traded companies in the energy sector. Same thing with finance, same thing with retail. Index funds were invented in the 1970s by Jack Bogle, founder of Vanguard. Jack invented the index fund because he was tired of paying the high fees associated with mutual funds. Because index funds mirror a preset index, there's no need for a fund manager. This eliminates many of the fees associated with a mutual fund. Index funds typically charge investors 0.05%. The third and final fund that we're going to talk about is called an ETF, or an exchange traded fund. An ETF offers the same diversification that a mutual fund and index fund offers, but it allows the fund to be traded like a stock for the investor. There are ETFs based on different indexes, different sectors, dividend stocks, etc. Whatever you could think of, there's an ETF out there for it. The big difference between ETFs and their counterparts are the flexibility and fees. Mutual funds can take days for investors to get their money into and days to divest from. Index funds can only be traded once per day, but ETFs, because they are traded like stocks, the investor can buy and sell it as many times as they want to throughout the day. This flexibility can also come as a drawback because it allows investors to trade off emotions, buying and selling based on temporary dips and rallies. In long-term investing, it's important to trust your long-term analysis over short-term fluctuations. These three types of investments are all shortcuts towards portfolio diversification and reducing risk exposure. Now, each of these comes with their own benefits and drawbacks, but they're all great for investors that don't want to monitor their assets every single day. Thanks for tuning in to Finance Today. Be sure to like, throw any comments and questions down at the bottom, and turn on post notifications for all of our upcoming content.